Traders use technical indicators to gain insight into the supply and demand of securities, as well as market psychology. These indicators work together to form the foundation of technical analysis. Trading volume, for example, can indicate whether a price move will continue. Indicators can be used to generate buy and sell signals in this way. If you're a new trader, today's video will show you about 8 technical indicators to add to your trading toolkit. You don't have to use them all. Instead, pick a few that you think will help you make better trading decisions. If you're new to the channel, please subscribe and enable notifications to receive more videos like this. In today's video on Trade, Invest, Earn, we will be looking at tools every new trader should know. So without further ado, let's begin. The first tool we're going to look at is the on-balance volume. The on-balance volume indicator, OBV, is used to measure the positive and negative flow of volume in a security over time. The indicator is a running total of up volume minus down volume. The amount of volume on a day when the price rallied is known as up volume. The volume on a day when the price falls is known as down volume. Depending on whether the price went up or down, each day's volume is added or subtracted from the indicator. When the OBV rises, it indicates that buyers are willing to step in and raise the price. When the OBV falls, the selling volume exceeds the buying volume, indicating lower prices. It functions as a trend confirmation tool in this way. If both the price and the OBV are rising, this indicates that the trend will continue. Traders who use OBV look for divergence as well. When the indicator and the price are moving in opposite directions, this happens. If the price is rising but the OBV is falling, it's possible that the trend isn't being supported by strong buyers and will soon reverse. The next tool that every new trader should know is the accumulation distribution line. The accumulation distribution line, AD line, is one of the most commonly used indicators to determine the money flow in and out of a security. It's similar to the on-balance volume indicator, OBV, but instead of focusing solely on the security's closing price for the period, it also considers the period's trading range and where the close falls within that range. The indicator gives volume more weight if a stock closes near its high than if it closes near the midpoint of its range. Because of the differences in calculations, OBV will perform better in some cases and AD will perform better in others. Because the stock is closing above the range's halfway point, the indicator line is trending up, indicating buying interest. This aids in the confirmation of an upward trend. If AD is falling, on the other hand, it means the price is closing in the lower half of its daily range, and thus volume is negative. This aids in the confirmation of a downward trend. Traders who use the AD line keep an eye out for divergence. If the AD line begins to fall while the price continues to rise, the trend is in trouble and may reverse. Similarly, if the price is trending lower and AD begins to rise, it could indicate that higher prices are on the way. Another important tool that every trader should know is the average directional index. The average directional index, ADX, is a trend indicator that is used to determine a trend's strength and momentum. When the ADX rises above 40, the trend is thought to have a lot of directional strength, either up or down, depending on the price movement. The trend is considered weak or non-trending when the ADX indicator is below 20. The ADX is the indicator's main line, which is usually black. There are 2 more lines that can be displayed if desired. DI plus and DI negative are the 2 types. These lines are frequently red and green in color. All 3 lines work together to display the trend's direction, as well as its momentum. The next tool on the list is the ARune indicator. The ARune oscillator is a technical indicator that determines whether a security is in a trend, and more specifically, whether the price is making new highs or lows during the calculation period, typically 25. The indicator can also be used to predict the start of a new trend. There are 2 lines in the ARune indicator, an ARune up line and an ARune down line. The first sign of a possible trend change is when the ARune up crosses above the ARune down. If the ARune up reaches 100 and remains relatively close to that level, while the ARune down remains near 0, it indicates that an upward trend is underway. It's also true in the other direction. If ARune down crosses above ARune up and stays near 100, it means the downtrend is active. Another important trading tool is the MACD. The Moving Average Convergence Divergence, MACD, indicator aids traders in determining the direction of a trend as well as its momentum. It also offers a variety of trade signals. The price is in an upward phase when the MACD is above 0. The MACD has entered a bearish phase if it is below 0. The indicator is made up of 2 lines, the MACD line and the slower moving signal line, When the MACD crosses below the signal line, it means the price is going down. The price is rising when the MACD line crosses above the signal line. Seeing which side of zero the indicator is on can help you figure out which signals to pay attention to. If the indicator is above zero, for example, look for the MACD to cross above the signal line before buying. If the MACD is below zero, the crossing of the MACD below the signal line may indicate a possible short trade. The next tool on the list is the Relative Strength Index. There are at least 3 major applications for the Relative Strength Index, RSI. The indicator plots recent price gains versus recent price losses as it moves from 0 to 100. As a result, the RSI levels aid in determining momentum and trend strength. An RSI is most commonly used as an overbought and oversold indicator. When the RSI exceeds 70, the asset is considered overbought and may fall. When the RSI falls below 30, the asset is considered oversold and is likely to rally. Making this assumption, however, is risky. As a result, some traders wait for the indicator to rise above 70 and then fall below before selling, or for the indicator to fall below 30 and then rise above before buying. The RSI can also be used to calculate divergence. When the indicator moves in the opposite direction of the price, it indicates that the current price trend is weakening and may reverse soon. Support and resistance levels are a third application for the RSI. A stock will frequently hold above the 30 level during uptrends and will frequently reach 70 or higher. When a stock is in a downtrend, the RSI will usually stay below 70 and it will frequently drop to 30 or lower. Another important trading tool is the Stochastic Oscillator. The Stochastic Oscillator is a technical indicator that compares the current price to the price range over time. When the trend is up, the price should be making new highs, according to the chart, which is plotted between 0 and 100. Price tends to make new lows in a downtrend. The stochastic determines whether or not this is the case. Because it is uncommon for the price to make continuous highs, keeping the stochastic near 100, or continuous lows, keeping the stochastic near 0, the stochastic moves up and down relatively quickly. As a result, the stochastic is frequently used as an indicator of overbought and oversold conditions. Overbought levels are above 80, while levels below 20 are considered oversold. When using overbought and oversold levels, keep the overall price trend in mind. During an uptrend, for example, if the indicator drops below 20 and then rises above it, that could be a buy signal. Rallies above 80, on the other hand, are less significant because we expect the indicator to move to 80 and above on a regular basis during an uptrend. Look for the indicator to move above 80 during a downtrend and then drop back below to signal a possible short trade. In a downtrend, the 20 level has less significance. The last tool we're going to look at today is the Fibonacci retracement tool. Areas of support and resistance are referred to as Fibonacci retracements. Before the trend continues in the original direction, this indicator uses horizontal lines to indicate areas of support and resistance at key Fibonacci levels. By drawing a trend line between the high and low, and dividing the vertical distance by key Fibonacci ratios of 23.6%, 38.2%, 50%, 61.8%, and 100%, these levels can be identified and used to make trading decisions. Every short-term trader's goal is to figure out which way the momentum of a given asset is going and profit from it. Hundreds of technical indicators and oscillators have been developed for this purpose, and we've discussed a few that you can try out right now. Consider incorporating these indicators into your current strategies, or developing new ones based on the indicators. Thank you for taking the time to watch. Don't forget to like, subscribe, and turn on the notification bell if you want to see more videos like this. Catch you in the next one.